The S&P 500 is at an all-time high in terms of price and almost also in terms of valuation. As you can see, the Schiller PE ratio is currently at 39, which is almost what it was in the 2000 bubble when it was at around 42, and therefore it is harder to find value. So let's take a look at 3 possible companies that might be undervalued. Stock number 1 is Intel, ticker symbol INTC, which is up 25% in the past week because of 2 main reasons. The most important one is because Nvidia has invested $5 billion in Intel, and reason number 2 is because the Trump administration has a 10% stake. Nvidia is going to team up with Intel to form custom data centers that form the backbone of AI infrastructure, as well as personal computer products. And as I've said before, the stock surged 27% in a single trading day. Nvidia bought $5 billion of Intel stock at an average price of $23.28 per share. This is huge news for Intel, and as we can see in their financials, this company has been struggling in the past couple of years. Their revenue was growing very nicely from 2015 to 2021, and then it started to make a big hit, and it is currently at $53 billion, so less than it was 10 years ago. The same has happened with their profit. As you can see, net income used to be at around $20 billion, and right now it is currently at negative $20 billion. The same with free cash flow. It used to be also at around $20 billion, and right now it is negative $10 billion because they are using all this money to try and turn things around. And obviously their margins have also plummeted, as they used to have at around 25% profit margin, and it is currently at negative 38%. However, analysts are expecting Intel to recover, as they are expected to grow revenue from $53 billion all the way to $66 billion in 2029. And in terms of EPS, they are expected to grow from 13 cents per share this year to $2.82 per share in 5 years. If you assign a 20p to the company, then this would make it a $56 stock, which means 87% returns. So great returns according to analysts if Intel recovers. In order to calculate the intrinsic value of Intel, I use my spreadsheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $22 per share, middle $35 per share, and high $53 per share. And because the stock is currently trading at $30 per share, this means that if my low assumptions occur, you're going to make a 4% annual return on your money, middle 12.5%, and high 20.5% annual return on your money. So great results according to these assumptions. And I think they are reasonable, as I have the company growing between 4 and 8% annually for the next 7 years, averaging a profit margin and free cash flow margin between 12 and 18%. And I assigned a PM price to free cash flow at the end of the 7 years of 14, 17, and 20. So again, I assume that Intel goes back to what they were doing before. Finally, regarding their balance sheet, they have $21 billion in cash and 50.76 in debt. So it's a decent balance sheet, and it's not that much of debt for a company that has a market cap of $142 billion. In conclusion, if you believe that Intel is going to turn things around, I think the stock still has a lot of upside potential, and we can see the company going back to $65 or $70 per share in a couple of years. However, I think this is a very risky play, and therefore I am not going to invest in the company right now. The second company that I'm going to cover is Adobe, which is down 22% in the past 5 years. Adobe's fundamentals are amazing, as their revenue has grown super consistently over the past decade from $4 billion to $23 billion currently. Their net income has also grown super consistently from $600 million to almost $7 billion currently. And one thing that I like about this company is that it has even more free cash flow, as it has grown from $1 billion to $9 billion currently in the past 10 years. And another thing that is great about the fundamentals of this company is the number of shares outstanding. As you can see, they have been heavily buying back a ton of shares, which is very positive for investors, as you own more of the company and you're sharing the profits with less people. Analysts are expecting fundamentals to keep getting better and better, as their revenue is expected to grow from $24 billion this year to $33 billion in 2029, and EPS going from $21 per share to $29 per share. So still a lot of growth expected for Adobe. Regarding my DCF model, Adobe is worth between $295 per share and $578 per share. Because the stock is currently trading at $367 per share, this means that if my low assumptions occur, you're going to make a 6.1% annual return on your money, middle 12.4%, and high 18.45%. As far as my assumptions, I have Adobe growing between 6 and 10% over the next 7 years, averaging a profit margin and free cash flow margin between 30 and 40%, which is what they have been doing, and I assigned a P/E price to free cash flow of 16, 18, and 20. If you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use as I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Adobe is currently trading at a forward PE of 16 and a price to free cash flow of 16, so I think it's fair to say that Adobe is clearly undervalued. As far as their balance sheet, the company has $5 billion in cash and $6 billion in debt, so this is an exceptional balance sheet. In conclusion, I believe Adobe is a great buy right now. It's a company with fantastic fundamentals, and the stock price is mainly down because of the market sentiment that it believes AI is going to ruin this company. I believe Adobe is going to benefit from AI, and therefore I would rank this company as a buy. And the last stock that I'm going to cover in this video is Chipotle, which I included in this video because it's trading near their 52-week low of $38 per share, and the stock is down 33% year to date. The revenue growth has been very solid and very consistent over the past decade, growing from $4 billion to $11 billion currently, so very solid revenue growth percentage. As far as their profit, their net income has also grown very consistently from $100 million to $1.5 billion. Similarly, their free cash flow has also grown, basically at the same rate as net income, and it is currently at $1.4 billion. And their margins are also very solid, with gross margin being around 40%, profit margin is currently at around 13%, and free cash flow margin as well at around 13%. Analysts are expecting fundamentals to keep getting better and better. As far as revenue, they are expected to make this year $12 billion and grow all the way to $19 billion in 2029. As far as EPS, going from $1.23 per share this year to $2.26 per share in 2029. So still a lot of growth expected from analysts. But let's take a look at the valuation. According to my DCF, the stock is worth between $14 per share and $31 per share, and therefore it seems like Chipotle is quite overvalued at the moment. Moreover, in terms of the valuation ratios, they are currently trading at a P of 35 and a price to free cash flow of 36. Now, in terms of their balance sheet, they have $1 billion in cash and $4 billion in debt, which is not a lot for a company that has a market cap of $53 billion. In conclusion, I believe Chipotle is a fantastic company. However, it's just too expensive right now, and it's a clear example of a company trading at a 52-week low doesn't mean it's cheap. I hope you found this video valuable. Let me know what you think about these stocks in the comments, and I'll see you in the next one.